Welcome to ForexTV.com. Today's Wednesday, April 29th. I'm Tim Kelly with your New York Forex Market Buzz. Dollar is down against the major currencies, but stronger against the yen at midday as global equity markets are rallying despite news that the U.S. economy shrank more than expected as GDP in the U.S. continues to contract. Crude and gold are also advancing. Now for a quick look at the headlines. Advanced GDP for the first quarter of 2009 contracted 6.1% against expectations of a 4.7% decline. The previous quarter's 6.3% contraction was unrevised. The negative figure is the fifth decline in quarterly GDP since the credit crisis began in August 2007. Prior to the release, forecasts range from an 8% contraction to a 2.8% decline. Personal consumption, which accounts for 70% of GDP in the U.S., grew by 2.2% in the quarter against expectations of a 0.9% jump and up from the 4.3% contraction in fourth quarter of last year. U.S. weekly oil supplies rose to a fresh 19-year high, while gasoline supplies unexpectedly fell, according to government inventory data released earlier today. In Europe, German Economics Ministry has revised its growth forecast and now expects the economy to contract by 6% in 2009, its sharpest fall since reunification. The previous forecast issued by the government had suggested a less pronounced contraction of 2.25% for the year. The European Central Bank Council member Axel Weber said Wednesday that he does not take too much stock from the so-called green shoots in economic indicators and that German economy will severely contract in 2009. The German economy, quote, is in a severe recession, he said. Just ahead, we'll have the FOMC policy statement with the so-called green shoots of economic recovery dominating much of the rhetoric from U.S. officials. Over recent weeks, economists question whether the Federal Reserve will jump on board at its monetary policy meeting on Wednesday, a little later today. After shocking the financial markets with an ambitious purchase plan for U.S. Treasuries in March, the Federal Reserve has continued to deploy an arsenal of unconventional measures to stimulate the ailing U.S. economy. And with only a portion of the stimulus unleashed, economists expect the central bank to maintain the status quo on monetary policy. Today we're joined by Jim Hyerczyk of the Pattern Price and Time Report. Hey Jim, thanks for joining us today.
No problem, Tim. How are you?
I'm doing great. I'm a little confused at the direction of equities, Jim, and I'm hoping you can help straighten us out here. Seeing some, what I would consider, and many others I've spoken to, a precipitous jump in equities today. Is this sentiment-driven? Is this liquidity-driven? What's your thought there?
I think it's liquidity-driven. I think last week traders were bracing themselves for a change in trend to the downside following the release of the preliminary bank stress reports. I think there was a thought process of maybe lightening up positions or not trading as heavily as they had been on the upside. And then the news came out about the swine flu over the weekend, and the first reaction was to the downside for protection. And it looks as if because of these conflicting fundamentals that many traders have decided just to take the week off, and so I think thin market conditions are attributing quite a bit to this rally today.
Okay, well that seems to be the case, and you know the so-called swine flu epidemic or threat of an epidemic or pandemic. It's not quite that yet, but we've unfortunately heard about the first fatality here in the U.S. Overnight. How much do you think that continues to weigh on the market? It's a very unfortunate situation, granted, but from a global markets perspective, do you think that this still has teeth, Jim?
Well, what happens is the economists start to crunch the numbers, and that's what the traders are really going to go after right now. It's, again, as we talked before about liquidity-driven market. If there's thin trading conditions and there's no stopper in the market's going to push the way of least resistance, which is up. But if the news starts to really gather strength and indicate that this is going to be a prolonged, have a prolonged effect on the global economy, then I think you'll start to see a turnaround in the market to the downside. Right now, you're really getting travel and leisure stocks getting hit, which is taking the focus off the banks. But at the same time, you're seeing pharmaceuticals and drug companies rise. So I think, as I said before, I think it's just the lack of major players in the market as they try to assess really what are the long-term ramifications of this potential pandemic before anybody really starts to take a position. The first move Sunday was naturally a reaction. People don't know. They want protection. And then as we start to see it develop and start to see some real numbers coming out, then I think that'll be the real move. But it may be several weeks before we see that.
Okay. Hey, Jim, I want to shift to debt markets. Treasury auctions see some pretty healthy demand. You and I had just discussed the issuance of government debt. What do you think that's lending to market activity right now and price movement? Can you give us your thoughts on that?
Well, as far as the auction's concerned, I think that the swine flu took the emphasis away from this auction that was taking place this week, the 2, the 5, and the 7-year note auctions. The Treasury raised about $101 billion. And going home last week, I thought that was going to have a major effect on the dollar, and it was actually going to be bearish the dollar because we are slowly increasing the debt. We have a contracting economy while we're increasing this debt, and that should be bearish the dollar. And our economy is starting to look a little bit like the UK. They've been punishing the pound because of a huge deficit spending as well as the contraction in the economy. And as far as the Treasury's concerned, or the Fed's concerned, I think their main focus right now is to try to see some kind of an exit strategy or a soft landing. And I think that as these rates are slowly creeping up, they're timing their buybacks to soften this rise in the rate, so it doesn't have that much impact on the market. So I think there is some good manipulation going on in the market, as well as possibly some asset allocation plays too, as traders try to ease between rising stocks and rising interest rates.
Okay, well, we are coming to the end of the month too, so it could be some squaring issues going on. I'd imagine right now. You're a former trader, so what do you think the end of the month effect is at this point?
Well, as I was saying before, when you do have an asset allocation play, the markets do trade a little bit different. You start to almost see one asset class moving while another one is holding still. And I think at times this week it looks like the bonds weren't moving at all, or the financials, while the stock market was driving higher. And then there were times today where the stock market was on a run and it stopped while they were working the other side of the trade in the financials. So as this allocation process is going on, you're going to see these subtle stops and starts. But overall, it looks like the way at least resistance is up in the equities, and as I said before, there's really no stopper in the market. So I think that the money is just driving the way at least resistance was, which is to the upside.
Hey, Jim, in the time we have left, I want to get your thoughts on currencies, and just ahead of the FOMC meeting, the meeting announcement, the lay of the land there. Is there anything we should be looking for in the statement? But prior to that, why don't you give us your thoughts on some of the major currencies right now?
Well, just looking at the FOMC, I think the biggest surprise will be if the Fed starts to talk about an exit strategy. I mentioned that several times during this conversation, but it's something that would really surprise the market because they would go from almost last month where we're buying back $1 trillion worth of assets to the next month announcing some way to get out of this strategy. And I think that would be the biggest shock if that came up. It's not being talked about a lot, but it is a possibility.
Well, Jim, let me interrupt you there. Is it in your opinion, is it the introduction of some new information that would potentially move the markets, or is it something specific that you may or may not be looking for?
I think it's going to be the introduction of a new topic. We've been talking about listening to the Fed and seeing if they can agree on a date that the market's going to bottom, the economy's going to bottom, and when the recovery is going to start. If you've noticed, they've talked about end of the year bottom, but a recovery in 2010. If they go away from that type of thinking, start talking about a way to eat out of this this flooding the market with cash, then I think that'll be a surprise. But otherwise, I'm looking for maybe the announcement of vax and also, again, some mention of when they see a bottom and when they see a recovery.
Jim, let's assume they do announce some new information. Where does dollar go?
I think the dollar is going to go down, and it's going to be hit hard because it would the traders again would be driven by the risk appetite, and that would put some pressure on the dollar.
Okay, hey, Jim, thank you so much for your insights. We're going to leave it there for now. I know you're busy ahead of this FOMC announcement, so we're going to leave it there for today. Thanks again for joining us.
Thank you, Tim.
This has been your New York Forex Market Buzz with Jim Hyerczyk. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on ForexTV.com.